So today's Cardinal lesson, we're talking about how to buy long-term care insurance. One version we're using as an example, and we're purchasing it with IRA money. And you say, well, why are you bringing the IRA into the thing? Well, that's where the money is. I mean, with a lot of our clients that are coming to us for financial planning, a lot of them are in their 60s, like this example, turning 65, going on Medicare. It's a great time to talk about protecting themselves for long-term care and increasing awareness. And then one thing that's become very popular is to buy long-term care insurance with a lump sum, to just pay one time and be done with it. And it covers you for the rest of your life, or covers both of you if it's a couple. And most people don't have a whole big wad of money sitting around that they can just throw into something like this. But a lot of times it's in a retirement account. That's where the people have the big balances. And so this particular company has devised a way to use a lump, a single premium out of the IRA, where you don't pay taxes on it all at once, but it serves as a single premium to cover two people for the rest of their lives for long-term care insurance. So that's kind of a summary of what's to come. I want to bring Tom on, and I want Tom to tell why we're doing this video today.
Yeah, I mean, we're doing this video to show you one example of how to pay for the care. And the reason you want to plan for this is if this crisis happens to you, who bears the burden of that is your family, it's your kids, it's your spouse, it's your loved ones. And what they're focused on is the money piece of it, is how do we pay for this care? And they're less focused on the care that you need to receive. And so, what we want to do and what we recommend you do is have a plan in place that solves for the money part of it. How do we pay for the care you need? So then when the crisis happens, your family can be focused on you. They can be focused on the care that you need. Where are you going to be most comfortable, and less about how they're going to pay for that care. And so I want to bring up the show notes here. You can find these at the link below our video. They're also on our website, and we have the board, and then we have the illustration that we're going to go through. I'll spend a little bit of time here, but if you want to look at this more closely, you can go to the show notes. This is specific to a couple, a husband and wife who are both 65 years old. If you're younger, you get more benefits. If you're older, you get less. It can change based off state. So again, if you want this for you, just give us a call and we can run you an example. But let me just scroll down and walk you through sort of the how the policy works, sort of how the flow of the money and the benefits that you get for what we're showing here. When you're looking at the board, this is at the bottom part of the board here. But what we've showed is 200,000 of IRA funds going into this policy. The company is OneAmerica. What they do initially is they give you a 25% bonus. So if you put 200,000 in, it bumps up to 250, and then that's spread out over a 10-year period of time. So what they're doing internally in the policy is that 250 is divided by 10, $25,000 a year is coming out of the IRA. So you have to pay taxes when that 25,000 comes out, and it's going to fund the life insurance policy. The life insurance is set up as a 10-pay policy. So after 10 years, the policy is paid up. The long-term care policy is paid up because this is a life long-term care hybrid policy. And it also really all you're having to do is do the initial transfer of the 200. That then your part is done, other than the taxes you owe on those distributions out of the IRA. What you get for that is a monthly benefit of $7,335 a month per person. That's good from day one. Once the policy is issued, those benefits are available. And this particular policy is a lifetime policy. So there is no end to those benefits. If you needed care for 10 years, you'd get that monthly benefit for 10 years. And then if both you and your spouse need care at the same time, that monthly benefit gets doubled, right? Because both people can claim that same monthly benefit. So that's really sort of the long-term care aspect of it. It is a life insurance policy. And so if you never need any care, there is a death benefit. It's 176 for this couple that comes tax-free to the beneficiaries if no care is ever needed. If some care is needed, that reduces the death benefit dollar for dollar, and then the remaining amount still goes to the kids. But if you between this couple, if they both used between the two of them 176,000 of long-term care, there's no longer a death benefit, but then the long-term care benefits last for as long as they need. One of the things, and again, there's a lot of numbers on this page. This just really shows the 25,000 coming out of the IRA over the 10 years, funding the life insurance policy. I don't want to get too far into the weeds here, but if you study this and have some questions, reach out and let us know. And so I'm going to turn it back to Hans here, and we're going to go through some of the sort of the features of the policy above and beyond sort of just what the monthly benefit is that you're eligible for if you need care.
Yeah, and I want to point out this lifetime benefit. This is the only company that offers a lifetime benefit. And lifetime or unlimited means the same thing. Is a lot of people are going to say, well, doesn't 4 years take care of most people? Well, yes, about 80% are of long-term care uses or stays are done at 4 years or before 4 years. But the other 20% is growing, and that could be as much as 10 years. People with memory, dementia, they need to be watched and cared for and guided. Those people are living longer and longer and longer. They're diagnosing it earlier, and that's people that are in their 80s and 90s now that are paying claims. What's it going to be 20 years from now or 25 years from now? So I just want to point out this policy ensures that you don't have some sort of end to your monthly payments for long-term care. As long as you're alive and as long as you're needing care, the policy is going to pay out. It's also, if we're writing this on two people, then which this is how this policy works, is you can't have the first spouse to use it using up the benefits of the second spouse. So there's a lot of nuances in this policy, but I want to emphasize that if you're both using it for long-term care at the same time, this thing's paying out almost 15 grand a month if you're both in the situation. And it can pay those benefits at home. I really want to emphasize the informal care piece of this. So you could take this 7335 monthly benefit and take 75% of it, which is going to be around 5 grand, a little more than 5 grand a month, and you don't have to send in receipts. You don't have to send in the license of your caregiver. They're just going to send you a check and you can spend it for your care. Now, obviously, you're going to have met the conditions of a claim, which we're going to get to those in a second. But I just want to point out is that's the informal care, so that people, especially on the front end of a claim or the first year or two, people that want to start at home and they want the flexibility to set up their care and perhaps being given by a daughter or son or son-in-law, daughter-in-law, a very close sister or brother, that kind of thing. It has that indemnity feature to it. It also, when you're utilizing the informal care, they have a hotline or the caregiver consultant at this insurance company that will coach that person who perhaps isn't experienced enough and answer their questions and direct them to places. Now, for the formal care at home, you've got a wide choice of the ways you can utilize that. One is through independent providers. So as long as they're licensed, you can have an independent provider. They're going to allow that. A home health care agency, and under home health, there's a lot more than they do than just come out and help you with bathing and dressing and eating and all that kind of stuff. You can have meal preparations, you can have meals brought in, you can have people do housework, yard work. Now don't be thinking you can just buy this policy and call people up to mow your yard and clean your house. It doesn't work like that. But if you're using the care anyhow, as you're bringing the aides in, the professionals through the home health care agency, they can arrange for all this other stuff to keep you at home. Adult daycare. Adult daycare that's a lot where there's daughters or sons who are taking care of the person, but they work. And so they're taking care of you. They can take you to adult daycare during the day. They can go to work and then come get you, or you can arrange rides to that, and the insurance company is going to pay for that, where you're there during the day, they're working, and they're caring for you at night. And then supportive equipment and tools and things to modify your house so it works. It's just, if we look right now, when people are filing claims on this type of insurance, a lot more and more and more of it is starting at home. Some of it is lasting for the entire amount of the claim. People are able to stay home. And when I just look to the future, especially as we look through COVID that happened a few years ago, it's just more and more of this is going to be taken care of. They're going to be used at home. That's where I want to stay with my policy if there's any way possible.
I want to jump in real quick here
Sure.
on that informal and formal care difference. Is that is a choice that you make at the time of filing your claim? So both are available to you. And again, if you do the informal care, it's 75% of the stated monthly benefit. If you do the formal care, you get the full stated benefit, and you can go back and forth, right? You could start on one, switch over to the other, or vice versa. And that's a decision you make in the future when you're actually filing a claim.
Okay. Now, go over here to the benefit triggers. And this is a question that it's a signal to me that too often, too quickly, I just jump into the numbers, and Tom does as well. And when we get people asking, well, what do I need to do to get this policy activated? I've read that some of these insurance companies make it pretty hard for you to start collecting the money. And I think historically that was true. When you get policies before the year 2000 in the last century that were written before then, that can be difficult. These policies were standardized when the IRS ruled and made what's called the tax qualified long-term care policy. So when you go into a tax qualified long-term care policy and you read it, the wording and the language is identical from policy to policy to policy. We've done other videos on that. You can go back, and I pulled it right out of the IRS code and put it in the show notes. But for this particular policy, let's just focus on that for today. These are the 6 activities of daily living: bathing, continence, dressing, eating, toileting, transferring. So you need need assistance with 2 or more of these. And in my experience, when I help clients with claim, what I'm going to focus in on, and I'm going to direct them through their doctors and their caregivers to focus in on bathing and dressing, because those are the 2 things. It's what I did for my mother to help her with her claim. It was pretty easy to make a case that she needed help taking a bath. It was a danger to her to do that all by herself in terms of the hot water and slipping and falling, toweling off, all that kind of stuff. So bathing is a pretty easy one to prove. Dressing, same thing. She had dementia, Alzheimer's, and she had terrible time matching up clothes. Some of the combinations she would come out with and she had difficulty getting the things on right and backwards and not forwards. And so again, bathing and dressing are the 2 easiest. And usually when people need help with those 2 things, they're going to need help with some of these other ones. But what people do when they're filing claims too often is they zero in on something. So anyhow, you need to meet 2 of the 6 activities of daily living. And then we want to go to the or thing, because I should have written a big or right here, okay? And the or means is if you have a severe cognitive impairment, you don't need to do the 2 of 6 activities of daily living. You just simply need to have your doctor certify that you have a severe cognitive impairment, and that's in and of itself. So it's one or the other. If you have both, then not a problem, but you only need to meet 1. So there are people that have a severe cognitive impairment that can do all 6 of these, but they need to be watched, they need to be supervised, they need to be helped, they need to be driven places. So that's the benefit triggers. When we get into the elimination period on this policy is, what an elimination period means. It's like a deductible. If you just go into a facility and you're only there for like 10 days, and maybe you had surgery, you go to a skilled nursing facility and you're there for 10 days and Medicare covers it and then they release you home, you're not going to get any benefits out of this policy because there's a 90-day elimination period when you go into a facility. So the first 90 days, they're not going to pay for it. Okay. But if we switch to the home benefit, there's a 0-day elimination period for informal care, home health, or adult daycare. So if you use any one of those three things, there's no waiting period. It pays from the first day. And those days count if you later end up in a nursing home or an assisted living, then you don't have to meet this 90 days if you've met it through using uh, the elimination period of 0 days. So I want Tom to talk a little bit really about those 4 points.
Yeah, I mean, I think it is a common question we get on these benefit triggers. Like Hans had mentioned, this is actually written into the tax code of sort of what qualifies as a tax qualified long-term care policy. So this is pretty standard across the board with pretty much every long-term care policy that's being written now. Old ones, not as much, but we're talking about, back in the 90s old, but any recent policy is going to have these same provisions. And so it's pretty standardized. And then sort of the elimination period, you have the 0 days at home, and the care you receive at home actually counts towards those 90 days for if you had to go to a facility. So if you started at home, you used it for 3 months, and then you got worse and had to go to like an assisted living or a nursing home, you would have already satisfied those 90-day eliminations. And that's a one-time period throughout the whole policy. So if you use it and then get better and go home and need to use it in the future, you don't have to re-satisfy that 90-day elimination period. So I think that's important to know. And like I had mentioned earlier, is the formal care and the informal care, that just gives you some flexibility of how you want to use this down the road. I will make a point that this version of this policy is not available in 11 states in DC. Some of them are coming on where they're introducing this version of the policy. But if you have some questions and you call us, we'll let you know what's available, what's not in your specific state. But this could be different. There's a version of this policy in pretty much all the states, but this particular one is not in all of them yet.
Okay, and let's talk real quickly about the care benefit concierge. And that's simply, you're going to have one point of contact. I mean, it's not the claims department. So you got to go through that. We'll help you with that if you buy the policy from us. Even if you don't, we help people all the time getting that initial claim going. And once that's going, then you're assigned the care benefit concierge, and you're going to have one point of contact to deal with everybody at the insurance company. So, you can fax things to them, you can scan them and email them to them. They can make phone calls, they can contact doctors, care providers. They can help you line up care if you're trying to line up home health care, find agencies for you, handle direct payments to providers, making sure the money flows where it needs to go, work with and just help you or your power of attorney and establish that relationship, get the power of attorney on file. So this company and many of the companies have developed a system because they know that that's real threatening for the adult children of people filing claims. It's just threatening, it's pain. There's a bureaucracy there. And so they've worked at making this process smoother and better for people through one point of contact. Now, I want to just review the policy again quickly because we're just showing you an example of two people 65, $200,000. And we make it round numbers like that because if you're a couple and you're older than 65, then you got a choice. Is you could either pay more or you could get less if you wanted to pay the same. If you were both 70, you put $200,000 into this thing, you're going to get less than this. Perhaps you're both 65 and you look at this and you say, well, that's not enough. We have many people put into this policy 250, 300 for a couple just because they want more benefit for life. So we can do that. If you're a single and you look at this, it's not exactly half. So if we had a male or a female, females are a little bit more, but it works pretty well to just take 100,000 of IRA money on a single person and then run the illustration, and which is a lot of the numbers are just going to be half other than the benefit number. So what you really need to do if you're interested in this is just contact us. You could even send us an email and give us your particulars, and we'll fix an illustration for you, like the one in the show notes, and just email it to you. So you could get a ballpark of what you can buy. I mean, the best way to do that, a lot of times with illustrations, people are lost. So you can just give us a call or arrange something through one of my assistants, one of our assistants, just where we could talk. So I also want to point out that the spreading of the taxation is really something. I mean, nobody wants to take a $200,000 hit in taxes or have that added to their income. That's why they set up the policy the way they did. This just smooths it out over the years. And when you get to minimum distributions, this money coming out of the policy can count under your RMD. So that's another thing for people. We have people do in their, in their 70s, a lot of them, where they're thinking more about RMDs. They can actually structure this policy around, and they're going to get 10 years or some amount of that is going to count toward their RMD. So that works out pretty smoothly. So within the context of comprehensive financial planning, this is one of the first things that we're going to deal with in the financial plan, and we're going to talk about, but we deal with all 7 of these items, and we evaluate your finances and make recommendations in all 7 areas. What we've talked about today is obviously the 3rd area, long-term care, and then we've covered the area of IRA 401k, because this is a plan to distribute your IRA 401k. We've talked about estate planning, because this is, you put the 200,000 in, you get the taxes spread out over all those years, and if you never use this, you and your spouse, there's going to be 176,000 paid tax-free to your heirs. If you just use it a little bit, then that'll be deducted from that. But we've covered estate planning, and then taxes. I mean, that's a big issue in retirement planning, is taking the taxation of an IRA and spreading it out over your lifetime. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.